Good morning, everyone, and welcome to today's webinar. I'm John Kirk, the president of the Employee Benefits team at CCIG. Here at CCIG, we're consultants and brokers of high-performing strategies in employee benefits, property casualty coverages, and coverage for high net worth individuals. We thought it was timely and important to organize this webinar today because we're ready to embark on the second half of the year. The seasonal march for most 2021 health insurance program renewals amid the most volatile time in healthcare and insurance dual history. There are new developing insights to share for the employer's lens, and we also wanted to have a healthcare expert with us today applying on the volatility from that important perspective. We hope that by the end of this 45-minute discussion, you'll feel better informed about today's landscape, impacting your decisions you'll be making for your 2021 renewal. Before we get started, a few housekeeping items. We'll be recording today's webinar, and the recording will be sent to all registrants tomorrow, including all the data sources and studies we discuss. All of our attendees are listening using their computer speaker by default, so there's no need to mute yourself. That was done automatically. You'll have an opportunity to submit questions by typing them into the chat panel of your webinar control panel under questions. Submit questions at any time during the presentation, and we'll address as many as time allows during the Q&A session in about the 15 minutes post 10:30 hour. We have our teammate Joseph McCleskey joining us off screen here, handling the intake of those questions. Joining me today as co-host from CCIG is Mike Birch, one of our vice presidents of employee benefits and a healthcare finance expert. And our special guest is Dr. Eric Bricker from Dallas, Texas. Eric is a Johns Hopkins trained internal medicine physician and former co-founder and chief medical officer of Compass Professional Health Services, an employer and consumer health navigation service with over 2,000 employer clients, which was recently acquired by Alight Solutions. Today, Dr. Bricker is a leading business voice in the healthcare economy with his healthcare finance video journal, A Healthcare Z, breaking down the economy from hospital insurance contracting to pharmacy benefit managers to case studies of employers that have successfully increased quality and decreased their costs in their health benefits program. Dr. Bricker, welcome. Mike, welcome. I'm going to turn it over to Mike Birch. Mike, lead us off this morning.
Thank you, John. Good morning. Glad to be here, Dr. Bricker. Appreciate your presence here. Just to dive right in, if we call up this first slide, John, and this question's for you, Dr. Bricker. To say healthcare is broken, I think, is a wild understatement. If we look at this slide here, we can see nearly 700% increase over the past 10 years and about 76% for families or deductibles in the past 5 years alone. You don't have to be a mathematician or a wizard to look at this trajectory and say something's wrong. Particularly if we look from 2010 to now, you see that gap widening even more. So Dr. Bricker, in the past 5 years, from your perspective as a physician and a healthcare finance executive, will you talk to us about why we've gotten to this place and the cause for these unrelenting cost increases?
Well, thank you so much, John and Mike, for having me. And just as a quick mic check, can you hear me okay?
Yep.
Okay, wonderful. Well, thank you so much for CCIG for having me, and thank you for all of you for attending today's webinar as well. And really, as employer healthcare costs have gone up, that is because of intentional strategies on the part of providers to increase their revenue, right? I mean, I'm sure many of you are familiar with Ray Dalio from Bridgewater Capital, who's the founder of the largest hedge fund in the world. And economic truism is one person's spending is another person's income. So what you've shown here is the spending by employers as it relates to their healthcare costs. But that is on the flip side, that is the income of doctors, hospitals, pharmaceutical companies, medical device companies, health insurance carriers, et cetera, et cetera. Now, those organizations, this is their top line revenue, and they dedicate a tremendous amount of time and strategy to increase their revenue. In other words, increase your costs. Now, this is done through, now I'm going to tell you the incredibly complicated healthcare cost equation, okay? It is the price per unit times the number of units. In other words, your healthcare costs are the price of a CT scan times the number of CT scans, the price of a gallbladder surgery times the number of gallbladder surgeries, the price of medication times the number of medications. That's all it is. And so that strategy for healthcare providers also then breaks down into two categories: things to increase the volume of tests and procedures and medications and medical devices, yada, yada, yada. Okay, that's one. And then the increase in the cost of each of those. Now, over the past 5 to 10 years, there's been multiple studies that have shown that the actual utilization of healthcare services, or the units, has actually remained stable. And so what's been going up over the past 10 years or 5 years has really been the dramatic increase in the cost per unit. And that's been because of a number of reasons. So number one has been because of horizontal integration across the healthcare system, where hospital systems have merged and physician groups have merged. And what they've been able to do specifically on the employer side is to negotiate higher contracted rates from the insurance carriers. And this is especially true in Colorado, where you do not, especially for large health systems, you don't have a ton of choice. And so when these large healthcare systems in Colorado go to Blue Cross United, Cigna, Aetna, et cetera, and they negotiate their in-network contracted rates, both for facility fees and for professional fees for large physician groups, then those insurance carriers, their hands are somewhat tied, because if they say no, then essentially that large healthcare system is going to be out of network, which is essentially a non-starter for you as an employer if you're going to purchase that insurance. If you're like, hey, insurance company is XYZ provider in your network, and if they say no, then you're probably not going to buy their insurance. So they're, to a certain extent, their hands are tied. The insurance company's hands are tied from a negotiation standpoint. So I could go on about this, but I'll just pause right here. That has caused some of what has gotten us here today.
Yeah, thank you for that. That is fascinating, but easily broken down. The price per unit times the number of units equals the quagmire we're in. So we're living in a tumultuous time, as we know. Absent COVID, we still had a fundamental healthcare crisis related to cost and access and things of that nature. Now you couple that issue with the biggest event of our lifetimes in COVID, that's got to do something on top of what you just said. So John, for you in particular, where do you see the volatility coming into play for the healthcare costs reacting to the COVID-19? And how do you think that will impact the health insurance markets in the next year or two?
Yeah, and Eric, jump in here with me. Mike, thank you. For the last 75 to 90 days, we've been watching the data come through, which of course has a lag on it, about maybe 30 days or so. But what's really telling is the volatility that the healthcare economy, from just supply and demand, is experiencing, and how that is going to impact insurers downstream in, let's say, 60, 90 days. What we're seeing right now, Mike, is the first is the utilization of services just virtually almost stopped from a non-acute or an elective basis in the month of April. This slide right here will show you that hospital expenditures from healthcare consumption as a consumer is down 40%, and physician services is down 45%. These numbers are staggering, and for the first time in our economies, they've really never experienced anything. So the volatility we've got is healthcare utilizations are down. So we can only expect that, since no one's using the system, that reduced costs or expenditures will also be down. Insurance companies are kind of in a surplus position right now in these past 90 days, for now. What's been interesting is, as we've been watching, our insurance earnings calls in the first quarter were quite telling. They were speaking about significant uncertainty, not only in the first quarter, but entering into the second quarter of April, May, and June. So I think what we've got here is, I look at kind of a dollar sign on its side when you look at a visual of volatility of some positives potentially in the insurance world of people spending less, so potentially they might incur less costs over time. But also, are we headed toward pent-up demand into the second half of this year and into 2021 in a simple demand-supply economic model, where we've got pent-up demand on the same amount of supply? Will that increase price? I don't know. But Dr. Bricker, you have analyzed one of the leading actuarial studies that's out there from Milliman. Tell us what you saw inside of that Milliman study with, I think it had maybe about 2 months of data.
Yeah, so the Milliman study, and the folks there at CCIG have the link to the study. Certainly, I'm sure they'd be happy to share with you as well. So their own actuaries modeled out 30%, 45%, and 60% drops in healthcare utilization and an unemployment rate of about 17.9%, which lo and behold, that's about where we find ourselves, and it might still be on the way up. Keep in mind, in the last recession, unemployment peaked at 10%, so we're almost double the unemployment rate. And so the reason for the decreased healthcare utilization has been because people are just not going to the doctor, right? People are voting with their feet, and they're staying away because of the fear of coronavirus, and they're not having these elective tests and procedures done. And I'm talking about elective spine surgery, I'm talking about elective joint replacement, I'm talking about endoscopies, I'm talking about cardiac stress tests, and these from commercially insured patients. In other words, your employees and their family members, these are the quote unquote cash cows for hospital systems. This is where they make all of their money. So on a volume basis, it doesn't necessarily make up the bulk of like the patients that if you walk into the lobby of a hospital, you won't see these people. But they make up the lion's share of the dollars because, again, I'm sure as many of you know, the hospitals are reimbursed somewhere between 400 and 800% of Medicare rates for these types of services. So they're getting paid a ton for them, and the patients have vanished, right? There are orthopedic practices that have gone from their normal patient volume literally to zero. They have done nothing in the past 3 months. Now, what this means for fully insured groups is that you are still paying out your premiums. It's not like you have stopped paying your premiums. You are still paying them. And the insurance carrier is not paying out claims to the doctors and to the hospitals. As a result, they are holding on to excess amounts of your premiums. And the Milliman study estimates that that amount for the rest of 2020 will be just for, not just for fully insured, but for fully insured and self-funded is somewhere between $75 billion and $350 billion just for 2020 alone. Now, if you take that fully insured groups are about 39% of all covered lives, with the other 61% being self-funded, then you're talking anywhere from, what is that, like 40 to about 120 billion in insurance premium that employers are paying out that the insurance carriers are just holding on to. Now, how does that then relate to, this is where it gets a little technical, the required minimum loss ratio by the carriers as dictated by the Affordable Care Act. And that says that for employers with less than 50 employees, the insurance carrier, when they're fully insured, has to pay out 80% of the premium dollars as claims. And for groups over 50, they must pay out 85% of their premiums as claims. And then they keep the balance for profit, administration, yada, yada, yada. Okay, so what that means is that there is no way that the insurance carriers are currently paying out enough claims to reach their MLRs of 80 and 85% respectively. They're probably, I did the math on it, they're probably coming in somewhere at about 54% right now, and would come in at about 54% for the rest of the year if this is how things play out. So United Health Group has already announced that they're quote unquote, and quote unquote because you really got to look at the fine print on this one, is giving some of that money back, although they're only giving it out to small employers and individuals and folks on Medicare Advantage plans. Blue Cross of Michigan is starting to give some of that back. Again, you got to really look at the fine print there. Okay, so now that leaves a lot of other carriers. What's happening to the money? The money didn't vanish. And that's where, from a cash flow standpoint, and John's going to get into this later on, if you're a self-funded employer, guess where the money is? It's in your bank account. It is not in somebody else's bank account. So this is where the self-funded employers are reaping the windfall of this dramatic decrease in utilization. And to John's point, this has literally never happened in the history of healthcare in America. Like if you look at utilization curves, it has never done this before, ever. Okay, so this is a once, I think Mike said it too, it's a once in a lifetime occurrence that this has ever happened. Now, the final thing that I'll say to address John's last point is, will this then result in pent-up demand, which will come back? And the estimates are from the Institute of Medicine and from many other sources that 30% of healthcare services are not needed at all. Now, certainly there are going to be situations like joint replacements that they're not happening now, but they might happen in 2021, sure, because the person might not be ambulatory and their inability to walk is not going to change. Therefore, they're probably still going to get that knee replacement later on. But There's a lot of people who have migraine headaches. They go away on their own without imaging. There's a lot of people that have sought care for symptomatology that is unnecessary, and it creates referrals and more tests and more procedures and more tests and more procedures. And that domino effect is essentially not happening. And as a result, potentially as much as a third of all of this unused care right now is never going to come back. And it is not coming back soon. So those orthopedic practices that went down to zero, they have not gone back up to 100%. They're barely at 20, 30%. So if it comes back, it'll come back slow. It will not come back to the original level. It will not overshoot the original level. And with the potential for various waves of coronavirus, people may continue to stay away from the provider. So I will pass the floor back to you.
Yeah, great insights, Eric. Just from your gut perspective, how do you think the insurance organizations, if you're fully insured, are going to recognize this, this economic supply and demand volatility inside the system? Do you think they'll react within this year? They're traditionally not, Johnny on the spot when reacting to healthcare costs and trends. They tend to lag, by a certain time period. But do you think they'll react this year? Do you think we'll see it in rates, 2021 renewals? Or do you think we're going to have to kind of wait till 2021, the actual year, to begin experiencing some of these things?
That's a great question. So honestly, it depends upon how competitive the insurance marketplace is in Colorado, because the more competitive it is, then those carriers, probably the fastest thing that they can do is have their renewals in the fall be more price competitive for 2021. They're sitting on all this extra money, which, oh, by the way, per the ACA, they only have to pay back the excess in excess of the MLR that they did not pay out in claims. They don't have to pay that back until August of the following year. So the insurance carriers, for their fully insured business, they can sit on that money until August of 2021. So that means that if it's a competitive insurance carrier environment, then maybe they'll just turn around and they'll say, hey, then we're going to make our renewals better. Now, the challenge is, and oh, by the way, you've already seen that in other insurance markets, like the auto insurance market, right? The auto insurance, almost every single auto insurance company has already started giving money back. I got money back from Safeco, right? Almost every insurance company has already given money back on the auto side because it's a much more competitive market. Right? Now, to the extent that the employer market is not as competitive, then the insurance carrier is going to hedge their bets and they're going to be like, look, we don't know what's going to happen, so we're going to hold on to as much of that premium as we can in our renewal. So that's where now keep in mind that insurance carriers 20 years ago, they could shop like 15 different carriers, or insurance brokers, they could shop 15 different carriers. Now they can shop like 3. Okay, so the consolidation in the industry, frankly, has been somewhat to the detriment of the employers and the employees.
Yeah. One final question I'd love your opinion on, Eric. The Colorado Hospital Association came out with a report, I don't know, about 3-4 weeks ago that said and potentially estimated that Colorado specifically, the hospitals part of Colorado Hospital Association, are projected to lose $1.2 billion inside of this year. Can they raise their prices this year to recoup that, or will that kind of shake out potentially down the road in 12 to 24 months?
Yeah, so that's a great question, John, and that is happening with hospital systems and states across America. It's a very similar dynamic in other places as well, and that's where they, as their own employer, they're just going to have to cut their own costs. And you've already seen this in the form of layoffs and furloughs for their own employees. So, I mean, look at that, 40 on the slide, 45 and 41% decreases. You're not going to price increase your way to covering that. So they have to cut their cost structure, which arguably they were too bloated. They were too bloated in terms of number of beds and number of scanners, administrative staff, et cetera, et cetera. So, to a certain extent, while it is in the short term painful, these types of situations are helpful in terms of like, listen, I used to help my dad prune trees in our yard growing up. Listen, pruning is a healthy thing overall in the long run. Yes, it's painful in the short term, but it absolutely has to happen. Now, what will they do to try to increase their revenue? Again, there's 2 things they can do. They can either increase their prices or they can increase their volume. Now, they will increase their prices through horizontal integration, through consolidation, which to a certain extent, they might have hit the ceiling of that in Colorado. And frankly, there might be, the Justice Department, the state of Colorado, they have this thing called the Herfindahl Index, where they look to see how concentrated and anti-competitive a business is. State of Massachusetts has actually done a lot of work around this around Harvard, because Harvard isn't a monopoly, but it's so concentrated that it's potentially anti-competitive. So their hands are not necessarily totally free in Colorado in terms of consolidation, because if they consolidate, then they can go to the carriers and ask for even more money, and the carriers' hands are even more tied. So with that being said, and the alternative is to increase their patient flow, which they have done historically over the past 10 years by buying physician practices, especially primary care practices, and then all the referrals for their tests and their procedures and their surgeries then get funneled into the large hospital system and their high reimbursement rates. That's been their model. Here's the challenge. Are they going to use federal money to do that? Because to the extent that there are no strings attached to the $100+ billion that hospitals have received from the federal government, and to the fact that these primary care practices are hurting, if I was a hospital CEO, I'd be like, there is a fire sale on primary care practices, and I can take all this free money that I got from the government, and I can buy those primary care practices, and I can use that to increase my referral base. So that is rather Machiavellian. I'm not saying that they're thinking that way. I'm not saying that they're gonna do that, but I'm saying that other hospital systems in other parts of the country absolutely are.
Yeah, well, thank you.
Thank you. Thank you, Eric, for that. John, specific to you, we hear about false positives. Can you flesh that out for us a little bit? My fear is that because of the lack of utilization, employers are going to feel real good about themselves, perhaps if these insurers or carriers give them some strong, perhaps even flat renewals. Will you just talk about what a false positive is?
Yeah, and I think what we'd like to do is transition this part of the presentation to preparing for this volatility. And volatility for us is, we don't want to doomsday this, Mike and Eric. We want to talk about actually what the effects of the healthcare economy will bring to the insurance world as it relates to employer lens, in the middle market. I think some of the false positives are what Eric described in the actuary report, where you're in a claim surplus right now, potentially, where the premiums that were priced last, in 2019 for your 2020 plan, of course, didn't include the COVID impact. So you're in a surplus position today. Volatility in our eyes looks like, again, this potential pent-up demand that might or might not hit the system in 2021. So we're looking at insurers and understanding how they're going to react to where we see, and these are our terms, these false positives today, where there are claim surpluses because utilization is down. No one's using the system. But it will come back. COVID will recede at some point, and this will come back. Will it come back all the way? We don't know. And Dr. Bricker's kind of shared some of his thoughts. So the false positives are we're sitting in a surplus position because of utilization. But will that utilization come back, Mike, is the big question.
Yeah. So one more for you, John, as well. Given that it will level off at some point, how should groups be approaching their 2021 renewal? What kind of strategies should they be deploying?
Yeah. So we're beginning the seasonal March, right? It's June, and if you're a December 1 or January 1, which is the majority of the middle market employer health benefit renewal cycle, for the most part, I think preparing for volatility looks like this in our eyes right now. A couple lanes. If you're in a lane that you're insuring your health benefits through a health insurance carrier and you're fully insured and you're buying your premiums through just a complete risk transfer to one of the large insurance companies, I think your options are a little limited. You're inside their box. You're kind of inside their control. There's not a lot of data that they share inside that model, but it's a safe and predictable model for many employers in that market. I think inside of that, you could begin looking, of course, at reducing benefits. It's not our favorite strategy, but it does reduce costs if we're looking at volatile renewals in 2021. I would also use this data that we can share with you after the call in your negotiations with your insurers. The actuarial data, it's out there and it's emerging, and you could use it in renewals to say to the big three insurance companies, we believe our utilization will be down. The actuaries show us that. We want to negotiate with different information other than we just want percentages off of our renewal increase. I think some other things that are out there inside that lane of insurance, there are limited networks or narrow networks. It's not our favorite strategy, but they do reduce costs. So those are just a few things that I would suggest if you're in the insurance kind of carrier lane. If we're preparing for volatility and looking for solutions and actual ideas, Mike and Eric, I think you have to look at the lane that supports partial self-insurance. This is where the opportunity exists in our eyes. And you can self-insure with a carrier, insurance carrier, but you can also self-insure with kind of a best practices approach that we believe in. And this is where we see the evidence, Mike and Eric, really working today. We see partially self-insured employers taking control of all the pieces inside of an insurance organization that they actually do for you. They price claims, they pay claims, they have a pharmacy benefit management element, they have consumer navigation, they actually have a reinsurance arm in there. We believe if you're going to prepare for volatility, that you shift your mindset of one of control of all of those pieces. This slide right here where PwC talks about understanding your role and purchasing like you purchase other inputs in your business, exactly where we want our customers and potential customers to think. Shift that mindset. Better exists out there. And we know that it exists in certain pockets inside the healthcare economy. We just have to break out of some legacy beliefs, some status quo, and think about where those opportunities exist.
Yeah, even think about just some real practical ways. What if we just addressed the RX spend for a plan? What if we actually enlisted the help of a partner who was a transparent pass-through pharmacy benefit manager that wasn't owned by a BUCA, which is the Blue Cross, United, Cigna's, Aetna's of the world. They were independent. Their job was to get you the best pricing at a fair cost, and then charge a little administrative fee to keep going. What if we looked at that for a plan? What if we, like we do, looked at some partners that bundle the most common 100 surgeries that Americans have, and it was a flat fee, a fixed rate, transparent. You knew what you were going to pay before you even went into the hospital, and it was a third, if not a fifth, of the price that we're seeing in these other networks.
Oh.
And these large claims. What if we actively managed our plan document to speak to when a dialysis claims come through? Because statistically, 87% of these plans is going to hit a massive claim, typically every year. What if we had language that redirected that claim and dealt with it more prudently? Those are some of the strategies I see us deploying as well.
Totally, Mike. And Eric, feel free to jump in here. There are safe harbors that exist out there in 2020 and 21. They exist today that Mike was talking about. We see organizations who want to break free from the legacy norms of insurance-driven pharmacy management. Overnight, 25, 30% difference in cost reduction when they manage their own pharmacy spend. We see insurance captives as a great safe harbor because you're inside of a cohort, a pool of like-minded employers who their entire strategic mindset is to reduce costs and actually increase benefits for their employees. So it's out there, and it's actually out there, and it exists in many, many forms. Eric, do you have any thoughts on where you're seeing high-performing employers managing their costs?
Yeah, so, and this is honestly, John, Mike, this is a big part of the reason why I agreed to do this webinar for CCIG is because you guys have the right ideas. And really, the biggest challenge for employers during the tight labor market and the roaring economy of the past, 8 to 9 years has been complacency. Employers just haven't looked at it. And look, I get it. If you're a CEO or CFO, you're busy. Your most limited resource is your time. And there's only so many things that you can look at in a day. And so it's really just been out of neglect. And I can just tell you, because at Compass, we had 2,000 employer clients, most were mid-market, literally from Seattle to Miami, we had many Colorado clients. And I would say that for the mid-market, Colorado is greatly more fully insured than comparable businesses, especially in the Midwest, close by. So I would say that you are, and I can say this because I'm not in Colorado. John and Mike would probably be much more nice about it, but you are not amongst your peers in regards to best practices when it comes to how to manage your costs in the mid-market because of the great amount of fully insured business. It's not. Most businesses that are comparable to you in the Midwest or in the South would be self-funded. In Texas, we have self-funded groups to 90 employees all over the place, and they've been like that for like 20 years, and it's been very stable. Okay, so step number one is you gotta self-fund. Step number two is when you self-fund, you have your data so that you can use specific targeted interventions. Okay, so not every solution works for every employer, but on-site, near-site, direct primary care, having a transparent PBM that does not live off of the spread pricing and only works off like a per script basis. Reference-based pricing. I mean, now is a great time to do reference-based pricing because the providers, the docs in the hospital, they want patient volume like it's nobody's business. And so you can direct contract with them, or you could do reference-based pricing to the extent that you would be able to provide patient volume at 150% or even 200% of Medicare. I guarantee you that the doctor in the hospital, they would take it because right now they have nothing. That orthopedic practice that has 0 patients, they would take it. Okay, and to John and Mike's point, a traditional carrier is not going to offer that to you, and you're not going to do that with a fully insured platform. Now, look at Sarah Graff in Wisconsin. Look at John Tornes, the CEO there. Look at the state of Montana and Maryland Bartlett. There are best practices all over the place, and guess what? They pay half as much as you do, half. Okay, and their benefits in many situations are better than yours. And their employees are sicker than yours. John Tornes is famous saying, look, in Wisconsin, we're the land of beer, brats, and butterfat. We have incredibly unhealthy employees, and they offer a better plan that costs half as much. And I'll end with one final story. One employee left Sarah Graff, and he had gotten into a little fight with John Tornes, and he said, look, John, I'm not going to miss you, but I'm really going to miss our employee health plan. Okay, that's how good it was. So I highly encourage you to talk to the CCIG guys because they are thinking along the right lines.
Well, thank you, Eric. But what Dr. Bricker shares with the audience is large organizations are doing strategic and assertive and leaning into this entire process, and that doesn't exclude you. If you've got 50 employees or if you've got 47, you can do this. Or if you've got 470, you don't have to be the state of Montana. You can simply take those strategies and apply them to your own plan. Dr. Bricker and Mike, we're going to pause here and attempt our best at taking a few questions from our audience that have been coming through here. So hang on here for the next few minutes as we begin to take a few questions. Joseph, do you have a few questions for us?
Yeah, I have one that came through specific to when Mike Birch was talking about some of the different solutions around dialysis and pass-through PBMs. What are some micro steps that employers can take advantage of right now?
Yeah, I'll start that, and then you gentlemen fill in where I'm lacking. To John's point, you might be 40 people, you might be 400, 4,000. All of this is relevant to you. A micro step might be just having a solid consultant who knows what they're doing. Certainly would love it to be us, but there are plenty of other good consultants to really examine the document and examine the whole plan and how it's running, and to see if there is claims data, how we can maximize that claims data. If there's not, how we can get that claims data, and really, so doing first of all just an analysis. We do an observations and opportunity. We'd look at your PBMs, like we've said. We'd look at your networks. We'd look at our reference-based pricing, things that we can, and this is not, we're not talking about gutting benefits here. We're talking about getting more for less even, because we're so used to the last 20 years paying more for less. We want you to pay less for more. That is our goal. So those are a few steps. John, do you have any others that you'd add?
No, I think what's interesting in some of these strategies are some insurance companies deliver great value in what they do, and we continue to work with them in actually using their provider networks. And then you can self-insure and control every other element of your plan. So we use the best of the industry, and then we can help you kind of create a more strategic and stronger financial back office, if you will.
You know, a quick case study. We've got a client that we were fortunate to work with now, and they were stuck in this quagmire we're talking about. They had massive large claims. They weren't getting any data from the fully insured carrier. Well, what we did was we unbundled it, we took it apart, and we went to the market and picked our partners. We played quarterback, and we bolted in the right pieces. And they actually have that same carrier network that they did before, but we just took control, and that we were able to carve out some things for large claims. We were able to carve out these other things we've talked about. So what would have been a $2.3 million spend just by doing some of these strategies, we're talking 2.3 now to about 1.6. You know, that's a good 600,000 of real money back to the P&L. Those are real life stories, and that's what we do every day.
Had a question come through. How does a plan like this work when 20% or less are driving 80% of the costs? And can you discuss what you mean by cohort?
I think I'll take that. Or Dr. Bricker, why don't you jump on that?
Yeah, so at Compass, we used to see this all the time, right? So it's the famous Pareto principle. And so what you really need to do is that's why you have to be self-funded, because you got to look at the data and look at specifically what's driving your high-cost claimants. Okay, for most employers, it typically falls into 3 diagnostic categories of musculoskeletal, cardiovascular, and cancer. And the lowest hanging fruit of those 3 is musculoskeletal, because those fall into quote-unquote elective procedures. And they mostly fall into your joint replacements and your spine, and also your, to a certain extent, joint injections and imaging. And this is where employers are doing direct contracting with orthopedic groups, or they are doing reference-based pricing, or they are sending people to other parts of the state. I will tell you that in Colorado, you have a challenge in, west of Summit County. Right? Once you start getting out to Vail and all those places, if they stay local for these things, then those employees and your plan is going to get shellacked by the local charges. Okay, and we saw this in the claims. And so you are obviously going to get, frankly, probably a higher quality surgeon and a higher quality experience by coming to some of the larger cities on the east side of the range that are going to be much more cost competitive, especially if you direct contract with them. And so fine. If your group has a lot of young people, there are things that you can do on the maternity side, because one of your biggest cost drivers is going to be babies. Okay, if you're doing things on the cancer side, it really has to do with the medications. So your specialty pharmacy markups and rebates. The rebates on specialty pharmacy for cancer medications are unreal. If you are using a PBM associated with a BUCA, there are literally tens of thousands of dollars per prescription that are being given to the carrier and not to you. That if you changed your PBM, that would change. So the whole reason that you self-fund is so that you can use an analytical approach to find out what is driving your 20%ers that are driving 80% of your costs, and then doing something about it. This is a solvable problem. Again, I'd be happy to name many employers, and I will send those to John, and you can talk to them, because they have solved this problem. It is a solvable problem.
Yeah, I'm going to add to that, Joseph and Eric, on the cohort piece. Where we're seeing innovation and control and the evidence base is, when you buy insurance, you're somewhat kind of jumping into a blind pool of cohorts of middle market employers who are doing the same thing. And we've been studying and are quite experienced in the insurance captive market. The insurance captive market creates cohorts of like-minded individuals. And those like-minded individuals are partially self-insured. They're taking their data and doing something with it. They're driving that classic Pareto principle and focusing on, the elements of their plan that are driving costs. And imagine it's just classic. Everyone is on the same page inside of a group where you're sharing some element of claims and cost risk. So that's what I mean by cohort, Joseph, that you can actually find a group of like-minded employers who are they're relentlessly battling costs every single day in their plan.
Okay, and then another question came through. you're talking about these, creative solutions. On average, how large should an organization be before they're looking into a plan like this that's partially self-funded?
I've done plans that are as small as 15 self-funded if you structure it right, and large as, many thousands. So that whole swath is open for business for us. I mean, we don't want you to feel because you're under 50 that this is impossible. Now, are there some levers that can be pulled when you get above 50 and 100? Sure. But you're not relegated to the fully insured world forever because you're, say, 40. So I'd say that whole middle market is open for a conversation.
And I would just say too that if you talk to your existing broker about self-funding for small groups, they're going to start telling you some horror stories that might not be true. So obviously, if you're self-funded, you're still going to have specific and aggregate stop loss coverage. You're not going to be not covered. Okay, the more expensive coverage is the specific stop loss, not the aggregate. Okay, which means that like if you have an individual claimant over $100,000, that's when the stop loss kicks in. And then they'll tell you this horror story about lasering, where so-and-so gets put on dialysis and the stop loss carrier comes back and says, okay, well, we're either going to increase your premiums by the amount of the dialysis claims, which is like $500,000 a year, or we're going to laser them out and you are no longer going to have insurance for that individual. And guess what? There are dialysis PPOs and carve-out solutions that absolutely you can use for these folks. So again, I've seen it. Like literally, I've been in meetings and I've seen it with my own eyes, these scare tactics that are not factually based. Our record at Compass was a group of 30 that had been self-funded for about 11 years.
Yeah. Wow. Well, we're going to wrap up here. We've got about 1 or 2 minutes, but again, Dr. Bricker, it's been a privilege. Would you just leave us with some parting thoughts today? 1 or 2 things the audience should hear and take away from our time together?
Yeah, so getting the right advisor is the absolute right first thing to do. Now, how that advisor themselves is paid is incredibly important because I will tell you now because I'm not in Colorado, I can tell you this, that there are brokerages in Colorado that get paid very large override fees from the carriers that is in excess of the commission that they're getting just for your group. And that biases them towards the Blue Cross United States Aetnas of the world and away from TPAs. So it is very important for that broker to disclose all of their compensation to their entire firm, not to the individual broker, just to yourself. Because when you follow the money and you find how your consultant is being paid or your broker is being paid, then you will learn a lot of things about the lack of bias or potential lack of bias in their advice. And then number 2 is to take a serious look at self-funding, not just through your own broker consultant, but also by talking to other businesses in other parts of the country that have been self-funded for a very long period of time and have been very successful with it. Like I said, I'd be happy to provide you many, both in the Midwest and in Texas, who've been doing this for a long time. That's it.
Great. Thank you. Thank you all. Thank you, Eric and Mike, and thank you everyone for attending today's webinar. If you've got any other questions, we'll be sending follow-up tomorrow, a recording of this presentation, plus some of the studies we referenced, specifically the Milliman actuarial study with the 2 months of data that Dr. Bricker was speaking from. And look for an email probably sometime tomorrow with this information. On behalf of Dr. Bricker, A Healthcare Z, CCIG, thank you for joining us today and have a great rest of your day. Bye.
Thank you.